Live from Milan Fintech Summit 2023 here in Milan at Allianz MiCo. 2 days of working to talk about the future of fintech industry. In this moment, we are together with Matthew Longhurst, who is co-founder and COO at TreasurySpring. Thanks for being with us.
Thank you for having me.
So, Matthew, today we want to talk about the investments industry and what is the real state of the art of this sector today in a world where we have inflation, recession, crisis of economy, and a lot of other risks that we need to consider when we want to invest on something. So what are the best advices that you can give to the audience, but also how is the moment in we are living?
Sure. I think we're living through a very interesting moment at the moment with inflation where it is. We haven't seen inflation this high in a long time. We're seeing bond rates at highs. We're seeing in US dollars rates over 5%, extended out for long periods of time. Even in euro, which historically has had negative interest rates in recent years, we're seeing rates as high as 4%. And so in terms of investments, well, the area that I'm involved in is cash investment. Most people don't often think of cash as an investment, but actually, if you have millions of pounds in the bank, which lots of venture-backed companies will have, and lots of large companies, they have to invest that cash somewhere. They have to put it into a bank or into a government bill. And they're not necessarily thinking of that as investment. But it is, because you decide, who am I going to lend to? It's unsecured, and that is guaranteed by the government only up to 100,000 euros. And so this is really investment. And so what should you be thinking about when it comes to your investment? Well, you should be thinking about the credit rating of the bank that you're lending to. You should be thinking whether you're taking collateral from that bank or not in case the bank goes down. You should be thinking also about government risk as well. Should you be lending to governments? When I say lending to governments, it's buying short-dated government bills and bonds, traditionally considered risk-free. So there are lots of things to think about because we're in a world where banks are going down, not just small banks, but big banks, as we saw with Credit Suisse last year.
And under this point of view, with these so many challenges that you have said, what could be the role of fintech, and and how can we transform these challenges in opportunities, according to you, to keep growing in the market and continue investing in the market?
Absolutely. Well, I think fintech has a big role to play because it's difficult to get access to the investments that people should be making with their cash. And so fintechs like ours, but also others, can make it easier to do the research on where you should put your money. But also the difficult bit is actually placing your money with those institutions and providing platforms where it can be easily done with a small treasury team. Because certainly startups and scale-ups have different things to worry about, like growing their business, rather than where they keep their capital. And so making this as easy as possible, allowing that diversification to happen, and educating as well as to the risks that are being taken, because there are always risks, whether they're interest rate risks, liquidity risks, credit risks. And so I think fintech has a big role to play there.
So according to this big role, however, we need to also try to better understand the next trends, the next steps to do, but always starting from lesson learned, like that of the Silicon Valley Bank crash that in last month had a lot of impacts also on the investments market, but not only, also on the consolidated companies in the market and their cash flows. So what could be the most important asset to consider in this scenario, and what are the next steps to do in the right way to get finance, for example, from startups or to find the right resources to go ahead?
Sure. I think that Silicon Valley Bank was a wake-up call to many firms. I think there are two lessons to be learned there. The first lesson is the risks that Silicon Valley Bank was taking itself. So they were investing in very high credit quality instruments, but they weren't taking into account liquidity risk and interest rate risk. And what happened when interest rates went up was that their portfolio of very safe securities, but long dated, lost a lot of value in its mark to market. And so the liquidity risk they had to take when they had to sell those instruments led to the downfall of Silicon Valley Bank. And then on the other side, the firms which were leaving all of their money with Silicon Valley Bank, these were very large firms who are very connected in the fintech and startup universe. So it only takes a couple of Twitter messages on the market to say, oh, you need to get your money out of that bank, and you get the old-fashioned bank run. And so I think firms need to be thinking about how susceptible the banks are to bank runs, how correlated the depositor base is of a particular bank, how much of the deposits are insured. For example, with Silicon Valley Bank, only a very small number of deposits were actually insured, which means people had a real reason to get their money out quickly. Otherwise, they would take steep losses. And so I think it's a wake-up call to the world that we are in a phase of the cycle where banks can go bust. Again, not just small banks, but we've seen Credit Suisse as well. We've seen issues around Metro Bank in the UK recently. And so you need to keep an eye on what's going on, and you can't be oblivious, even while you're trying to build and scale up your company, to the economic realities and the business cycle that surrounds us.
And so thank you for your advices, your tips and spotlights, and for being with us today.
Thank you very much for having me.